Smartest data, quick definitions, leverage ratios. These ratios are critical in your due diligence when investing in equities. Let's get to the video and take a look. The leverage ratios allow a quick analysis of a company's ability to service debt. The ratios use items from the three financial statements and focus on the capital structure and the ability to service debt. Let's cut to the chase and discuss why it is critical to understand the debt obligations of a company. In bankruptcy, when a company fails to meet its debt servicing obligation, debt is senior to equity. Understand if your equity investment is at risk. To understand this, it is key to be fluent in the use of the various leverage ratios, which are financial ratios as opposed to valuation ratios. The leverage ratios are calculated using items from across the three financial statements: balance sheet, profit and loss, and cash flow. They are a set of ratios focusing on a company's capital structure and a company's debt servicing ability. Let's do some quick calculations on two commonly used leverage ratios. First off, with the capital structure, the net debt to equity ratio. The formula is net debt to equity equals total debt minus cash equivalents divided by equity. So if a company's got equity of 100 million and net debt of 130 million, what is the net debt to equity ratio? Okay, so let's put in the numbers. We are dividing net debt 130 million divided by equity of 100 million. Therefore, the leverage is 1.3 times. So what does this mean? This means that the debt level is greater than the equity level. Therefore, if the company cannot meet its debt obligations and has to be liquefied, it's likely that your equity investment will be at risk. Let's look at the company's debt servicing. The interest coverage ratio, the formula is interest coverage ratio equals EBITDA divided by interest expense. So for this financial year, the EBITDA was 40 million, interest expense of 8 million. So what we're doing is dividing EBITDA 40 million divided by interest expense 8 million. We have a ratio of 5 times. So therefore, for the interest expense, which is below the EBITDA line, it's covering that 5 times. Do you ever wonder why banks trade at a PE discount to the broad stock market? Banks have a regulatory oversight of their capital structure. Keep in mind, banks are just highly leveraged companies. In closing, 3 quick bullet points regarding the leverage ratios. First off, the capital structure. Net debt divided by equity. This is the liability side of the company's balance sheet. The next is the company's ability to service its debt. This is EBITDA divided by interest expense. The leverage ratios assist in understanding if your equity investment is at risk from excessive debt. Remember, in a bankruptcy situation, debt is senior to equity.